Are you looking for high dividend stocks that pay out quarterly or even monthly? For example, for your retirement or just to cash in on high dividends? Now, real estate funds remain interesting even in 2025. Since 2024, I've brought up the topic of real estate funds several times, and I've also taken positions myself, which I'll show you in this video. 3 great real estate funds that might be interesting not only for high dividends, but also possibly for long-term growth. That's what we're going to talk about in this video. Welcome back. My name is Jorik Vermeulen. I've been investing myself for over 10 years, and I founded Happy Investors with the goal of simple investing for financial freedom. For example, with our new concept win-win investing, you can copy our investment strategy from your own investment account. 100% control. No one can access your money, but you can still follow our investment strategy, and we have a high, proven return to show for it. Check out our website and you'll find our business model very interesting because we only earn when you earn too. So, no cure, no pay. That's about win-win investing. Welcome back. Real estate funds, that's what we're going to talk about. Personally, I've taken 4 positions in my Maxim account. This is a business investment account. As you know, I have multiple accounts. Every month, I also give updates about my stocks and ETFs. The real estate funds make up a total of 13% holdings, though. This is just one account, so if you had everything together, it's only about 4%. So, quickly calculated, 3 to 4% in real estate funds isn't all that much. I thought they would achieve a slightly higher return in terms of price potential. The return we see here is since inception, and that seems very low. But this does give a distorted picture, because we've also had inflation, the currency correction. The dollar has become worth a lot less than a euro. And yes, so here we have a negative effect from currency exchange. I can also demonstrate it. Here we see 4 different tickers. Vice Properties is still a great real estate fund, but we're not going to talk about that in this video. In this video, we're going to talk about 3 other real estate funds, but here you can see the total return from Vice Properties in my personal holding, which is 7%. It shows realized profit and loss is plus 500. Dividends are being paid out. You can see that here. Number of times bought, twice, and here we see dividend payments coming in. So, 150 in total. And the last one is that, yes, it automatically reinvests in the fund, so dividends are automatically cheaper. That's possible with Maxim. For example, that's not possible with the Gyro. I made a detailed explainer video about why I switched to Maxim. At least, for the most part. Simply put, the costs are much lower and you have a lot more options. So I choose Maxim. But that's beside the point. Here we see a total return of 7%. However, yes, the realized profit/loss is plus 500. But still, we just saw in my account that we were in the negative, so that has to do with the currency. The first stock we're going to talk about in terms of real estate funds is, well, a REIT, and if you pay close attention. Yes, I have that one in my own portfolio too. That's what we're starting with right now. This stock ranks number 2 among the selection of top retail funds, so basically real estate funds and retail. Think of apartments and that sort of thing, and a REIT has a long-term investment strategy. My total return hasn't been that great since the very first entry point. It's not even 1% yet. But you can also see the holding. The market value is also much lower than that of Vice Properties. That has to do with trust. If you trust a stock more, you invest more. If you have less confidence in it, it might still generate returns, but then you invest a bit less in it. So that has to do with allocation policy and a REIT. Let's take a look at that. It gets a 5-star rating from Morningstar. Let's open it up for a bit more detail. So the Morningstar rating is 5 stars. It indicates that it doesn't have an economic moat. In other words, does it have a competitive advantage? And according to them, the estimated intrinsic value is $49. Well, that's a bit above the current share price, so keep that in mind. The dividend they pay out is 5 to 6%. That's very high, so if you also get price appreciation on top of that, you can achieve a high total return. And I actually expected that real estate funds would deliver a slightly higher price return. But that's beside the point. Of course, I did receive dividends, so that still stands. That dividend continues to be paid out. But of course, you also want to have a higher total return. Well, Wall Street analysts aren't super enthusiastic. The price target is 44. Let's take a look at some other characteristics of this stock. Very quickly, we'll go through them. We see that the share price is below the intrinsic value, with price by AFFO being 15. AFFO is used instead of earnings. Even if we zoom in on a slightly shorter time frame, we still see the same effect. What does this actually mean? It means you could potentially achieve returns simply based on the price to AFFO. For next year, it's estimated at about 12.75. The 5-year average price to AFFO is somewhat on the lower side, around 15, so if we use that as a benchmark, it means we could potentially create a return from this current entry point of an average of 14% per year, or a total return of 40% over the next 2.5 years. This is quite attractive through the end of 2027, especially if you're looking for lower risk investments. And yes, indeed, it will move more steadily than a good stock. But strictly speaking, good stocks can of course deliver much higher returns, but also bigger losses. So choose the game you want to play. And real estate funds, of course, fall under high dividend stocks. Valuation is interesting. We see that at this moment it scores a strong buy on factor analysis. This is a tool that I find important and that I value highly. Of course, you should always do fundamental research. That means, what is the company, its business strategy, future position, future profit growth, management, and things like that. And here, we're only looking at data compared to the sector median. And in that, for example, the price for next year is indeed estimated at 12.7, 12.5. Well, that's also a lot lower than the sector median. So you actually have a 14% discount compared to the sector median. That doesn't necessarily mean it's cheap right away. For that, you also need to look at growth. The growth does seem to be somewhat higher than, for example, the sector median. Other growth figures are also around or above the sector median. So in that case, the valuation is lower and growth is comparable or higher. That's a plus. Then I also look at profitability. We see that profitability is much higher than the sector median. That's why you see these colors. I'm explaining it in a very simple way. Green is of course positive, and often that means it's also much higher than the sector median. But not always, as you can see in this example. Well, what we also look at are things like return on total assets, for example. That's an important metric, as is return on total capital. And both, in terms of profitability, are also above the sector median. So all in all, you could say, okay, there's a lower price tag than the sector median. And profit and growth are better, so this is probably a better choice within this sector. So why does it score high, number 2 in this sector? Does that mean it's a good investment? No, that doesn't necessarily mean that, because there are countless high dividend stocks and plenty of other stocks that might not pay a high dividend, but do have high potential. So you have to weigh everything against each other to make a good decision. And that's why investing is still quite tricky. It's all about opportunity costs. Alright, looking at the dividend, the high dividend for next year is estimated at 5.4%. The payout ratio is of course high for a real estate fund. It has increased its dividend for 34 years in a row. That's why I think this is a fun real estate fund to mention. Let's look at the technical analysis. We've already seen that fundamentally it looks interesting. At the moment, what's clearly visible in this pattern is a horizontal movement. But the momentum is starting to pick up again, and because other developments are also favorable, like profit growth for example, it could very well rise again to this imaginary line here, which some technical analysts apparently find relevant, namely a resistance level. And that's quite a bit higher than the current price. That means a 12% upside potential. So, what could happen? Just as one scenario, it could also disappoint, but if the stock continues to rise to this last resistance level, that's a 12% return, plus another 5% in dividends. You could achieve a return of about 10 to 17% over the next 6 to 12 months. If we're lucky and the stock rises further. For example, also because interest rates become favorable again or the investment climate in real estate improves for this company, it could just keep going, and then besides a high dividend, you also have price potential. So all in all, I think, even though there isn't a huge margin of safety, it could still be an interesting investment if you're interested in real estate funds and high dividends. And of course, that combination. A second top REIT at the moment is Macri Realty Corp, ticker symbol ADC. We've already seen that NN REIT was in second place, and now in first place is Agric Realty Corporation. Still, my personal preference goes to NN REIT, simply because the valuation is lower. I'll show you why. First of all, the current price is around $73 and the Morningstar valuation is about 72, so it's roughly fairly valued. That's why Morningstar gives it 3 stars. We see the ratings, but Wall Street analysts actually think it will go up, and their price target is much higher, with about 12% upside potential. And actually, this is a high-quality, strong fund. The only issue is the higher valuation, especially compared to other real estate funds. That's why, firstly, I prefer NN REIT. Simply put, a lower price tag gives you a bit more margin of safety. That doesn't mean everything. Of course, it also depends on growth. And when it comes to growth and profitability, Agric Realty actually scores quite well. So that's definitely something we need to take into account. If we look at the historical valuation, we see that this price is quite a bit higher than both the normal multiple. That's the blue line, which is the fair value multiple, meaning the price to FFO is about 15. Yeah, that's usually not a good sign. Even if we zoom in a little, we see that it's still above the orange line, but it does align with the normal multiple. The question now, of course, is how will the market continue to value this company? Over the past few years, that multiple was around 19, but in the past it was 15. So apparently, there's something going on that makes this real estate fund deserve a higher price tag compared to other real estate funds. So that's apparently the market's perception. Let's be cautious and, at least for now, use 15 as our baseline. Below, we see earnings growth expectations from analysts. The current price multiple is a bit on the high side, 17. Yes, if we stick to a price multiple of 15 over 2.5 years, then the potential is limited, with an average return of about 3.4%. Well, that's actually even lower than the current dividend being paid out. So, in our scenario analysis, we really have to assume a higher multiple. So the question is a multiple of 19.5 justified over 2.5 years? Because only then could we achieve an attractive return of about 10 to 12%. So that's why I do think this is the case. Yes, it simply carries a bit more risk. Expectations are a bit higher and you need to get a higher price tag in 2.5 years than, for example, NN REIT. So that's a consideration you have to make for yourself. Here you need to do more fundamental analysis. What is the position in this real estate fund? Why are they able to grow faster than others? At least, that's what the market thinks. Or is the market simply wrong and is it just a bit more overpriced? I'll get back to that in a moment. I don't think this is the right time to get in, but the factor analysis is definitely a strong buy, especially on strong growth and profitability. Revisions are also positive, so people expect the fund to make more profit in the coming quarters. However, valuation has increased, as we can see. We just discussed that, and the price for next year is also estimated at 17. Well, that's a bit higher than the sector median. 17 itself might not be super high, but as I showed, it's also about opportunity costs. The growth is strong, especially the revenue growth over the past 5 years. Historically, the CAGR is very high, especially compared to the sector median. But we also see other growth figures that are simply positive. Also, if we look at profitability, for example, well, good margins, that's all fine. The EBIT margin is also very high, and here we see the line for leverage free cash flow margin. It's simply double the sector median. So those are good things when it comes to leverage. On the other hand, profitability figures aren't that high, as you can see. The dividend for next year is estimated to be around a 4% payout. The payout ratio is of course high, but over 5 years it's not particularly high. 5% and 6 consecutive years of dividend growth, so less strong than NN and REIT. But of course, there are also plenty of other real estate funds. And again, VC Properties is not included in this analysis. But as I showed you, out of all the real estate funds I have, VC Properties is the largest position. I think that's the most interesting choice. But yeah, I've mentioned it so many times already. Now it's also time for some other real estate funds. Of course, all of this is purely for inspiration. Investing involves risks. This is not personal advice. You know the drill. Dividend growth, 6 years in a row, and 30 consecutive years of dividend payments, so it's definitely a solid dividend stock as well, of course. Is this the right time to get in? Well, we've seen that the valuation is a bit on the high side. Expectations are high, so that's a positive. But technical analysis sometimes plays a role. What do we see here? Here we see that apparently there is a resistance level at the all-time high. The last time the price reached that level was in April 2020, and it didn't break through, so it's now in a downward trend. If we zoom in, we can also clearly see that it's below the 20-day EMA. We see that the MACD is declining and the stochastic is also dropping. It could be that the MACD finds a support level here at that zero line, and that would then need to coincide with other support levels. So you should do further research on that yourself if you believe in technical analysis. Personally, I focus more on fundamental analysis. But in this case, this setup is interesting because you can clearly see a downward movement. So personally, I would wait a little while, especially considering the somewhat higher valuation, meaning a slightly higher price tag. Is it possible that the stock could drop? We do see that the last decline was quite significant, 26% compared to a similar price level in January 2023. So keep in mind that there could be a sharp drop in the share price, but apparently the market expects a lot from it. And that's the question, is the market right or not? If it is, and the price tag gets cheaper because of falling prices, there could be an interesting entry point. I have already emphasized myself that, okay, the expectations are a bit on the high side. Personally, I would count on a lower price tag, so a price drop to 15. That way, you're playing it a bit safer. Then these profit growth expectations also have to be accurate. That's the second part, and then we see that we could potentially achieve a high return if the price drops. But for that to happen, the price still needs to drop a bit further. CareTrust REIT is an interesting real estate fund, or REIT. In other words, a kind of dividend stock with the ticker CTRE. This fund, as the name suggests, specializes mainly in healthcare, that is, health centers, and primarily invests in real estate property. Interesting for dividend investors, since they are also required to pay out a lot of dividends. As for the economics, let's take a look at some fundamentals now. Morningstar's fair value estimate is $32, and the current price is $30. According to them, the economic mode is narrow. That's actually quite positive for a real estate fund. It means that, according to Morningstar, they may have managed to create a small competitive advantage. Analysts from Wall Street say that the price target is a bit higher, but not by much, also at 32. And that means there's a potential price increase of about 5.6%. The question, of course, is over what time frame. Are we talking long-term here? Or is it a price target for the coming months? If we look at it, should we actually set a price based on AVO? When we look at adjusted operating earnings, we always look at funds from operations, or AVO. And we see that if we look at historical valuations, after a significant run-up, the price is actually just a bit above them. Interesting valuation level. In other words, the price to AVO, which usually starts to get interesting below 10, of course, or at least 15, combined with growth, has now risen to about 18.4. That's definitely on the higher side. Not extremely high, but still on the higher side. And if we then look at the AVO growth estimates, so made by 8 analysts, quite a few up to 2027, and for that year there are 4 analysts, as we can see. Yeah, then based on a normal multiple, you'd actually want it to drop to around 14. Let's say it might turn out a little higher. 14.8, then the potential average return from the current price level could be 5%. How could this be higher? Simply, if these earnings growth estimates turn out to be higher than expected, which could be the case with Care to our street. But at the end, I'll let you know what I would do. Let's look at the valuation at this moment. That price multiple has gone up a bit, and for next year, a price to F&O or price to earnings is estimated at around 17. Well, that's definitely higher than the sector median. That one is indeed around 15. So yes, ideally you'd want to pay a somewhat lower price, because that gives you more margin of safety, while the debt to equity is actually quite favorable. Of course, there are a lot of other characteristics you still need to look at for this stock, especially the long-term strategy. But here, we're just showing a few fundamentals purely as inspiration for further research. The growth, on the other hand, is quite impressive, at least according to the estimates. And of course, this is compared to the sector median. That's why you see these figures. The revenue growth for next year is estimated at about 10%. That's significantly higher than the sector or median. So yes, in general, it's better to invest in funds that are growing, because revenue growth also creates more room for profit growth. That's just how logical it is. That's always nice. If we look at the F&O growth for next year, that's also up 12%, and the ROH growth is estimated at around 20%. These are all high numbers. If you're a beginning investor, this might sound like gibberish. For that, you can check out our in-depth videos on our channel or website, or join one of our courses. We make those available for just €39. That's a very low price. To be honest, the courses are a bit outdated, but the core content is still the same. Only the examples are a bit old, and of course, it's all about the timeless lessons we share in them, like how to analyze and value a stock or how to value an ETF. Those kinds of things lead to profitability. That's also strong for this fund, especially compared to the sector median. And for example, return on assets and return on equity also look pretty good, so for this fund it's mainly about growth. That's why it also scores high, a strong buy, based on the factor analysis. The dividend yield for next year is estimated at around 4.3%. Not extremely high, in my opinion. I think between 4 and 5% is just nice. Yeah, there are also funds with a 7% dividend per year. But then you probably have a very high payout ratio plus minimal revenue growth. The dividend has grown for 10 years in a row. So that's definitely a positive. For sure, I consider that a buy signal for the short term. Their price target is even a bit higher, at $34. That might not seem like a lot, but compared to the current price, that's about a 10% gain just from price appreciation. Suppose that happens within a year, then you have a 10% return plus another 4% dividend. That gives you a total return of 14%. Since 2022, we've been achieving a demonstrably high return with our dividend stocks at 17.4%. With our growth stocks, it's even an average of 30% per year. And we simply do that based on a proven methodology, sticking to that methodology and using this fund card as a guide. Although it might not seem super attractive, it's still quite possible to achieve a pretty decent return. And of course, the question is whether it can achieve a high average return over time. So, what would I personally do? I don't have any investment in this stock. I would actually wait a bit to see what happens if the all-time high is reached, and possibly if you're patient and lucky. And sometimes that happens, so this fund could maybe, in the short term, again, drop to a support line, just like it did here in February. And then you actually see that it could drop another 20%. If that happens, then the valuation we just saw becomes a lot more attractive. And then at least you have a bit more margin of safety, and your potential return also increases quite quickly. Provided, of course, that the good expectations remain the same. So, what needs to happen? Well, the price basically needs to reach the last all-time high. Then hope that investors cool off for a bit, sell, take profits, and that nothing fundamental changes. So the outlook remains good. Only the price simply drops based on traders, short-term speculators, and that sort of thing. People who think short-term, that's just part of it. There's a lot of money in the market, so that often happens. And if it then reaches a support level again based on an attractive fundamental level, so price to AFFO, then you buy more, and you actually have more margin of safety for higher returns and, in fact, also lower risk. So often, with a lot of patience, you can achieve high returns. But yes, it's also quite possible that the stock breaks through the all-time high based on even more profit growth than expected. And yes, then you might end up getting in too late or not at all. That's just part of the game.